Hi everyone. So today we're going to take a look at sales transactions. So in the prior videos, we've looked at purchase transactions, but remember now we are merchandising business. So our goal is to buy inventory, right, and then to house that inventory and then sell it to our consumers, right? And so this is the next arm of the process, is selling all of the inventory that we have purchased from our wholesaler. All right, so in the interest of making sure I make this relevant to what we learn in the real world, here you see Sprouts again. We're looking at, primarily net sales. So in the prior example, we looked at, their cost of goods sold or their cost of sales, and now we're looking at all of their other things. So we're going to specifically focus on, again, net sales, okay? All right, so let's evaluate this. Some of this will be from what we kind of sort of learned in a prior example, but we'll go with it, okay? So it says your company sells merchandise for $1,800. Assume that the cost of goods sold on March 3rd is $1,200, right? So it's a cash sale. So how would you record this transaction? Well, we would usually do a debit to cash and a credit to sales, as we've seen many times in prior like chapters. And then now the thing that we must account for that we talked about in the very beginning of this chapter is our cost of goods sold. So we're saying the cost of buying this inventory was $1,200, and we're doing a credit to our inventory. Our inventory is now decreasing. Now we have the same scenario but we have a sales on account. Now all the sales on account just means is it's an accounts receivable. Your customer has now provided you with an IOU, right? And so what they're saying is, I promise to pay you maybe within 30 days or whatever the terms is. And then you're debiting the accounts receivable of $1,800 and a credit to sales. And again, what does not change is the cost of buying that inventory from the seller, okay? All right, so now let's journey into what does it look like for a customer discount. So imagine you wear multiple hats, right? So in the first part of this transaction, we were looking at you being the purchasing person, right? You're going out, you're the Target person or Amazon, and you're going out to buy inventory. And now what you're doing is now you're putting on your seller's hat, and now you're going to sell this inventory, okay? So now you're on the sell side and you're selling it to your customers. So it says the seller may offer customer discount to encourage early payment. Very similar to what the wholesaler did or provided for you, right? And this is just, you want to provide a discount because you want to start the process all over again, right? So maybe refer back to the earlier slides when we talked about the operating cycle of a merchandising business. So for example, a seller may offer credit terms of 210 net 30, which provides a 2% sales discount if the invoice is paid within 10 days. All right, so here's our example. Your company sold $18,000 of merchandise to digital technology on March 10th with credit terms 210 net 30. Now, before I reveal the answer, hopefully you can maybe write down what does this journal entry look like, okay? So what that looks like is, because it is on, because they didn't pay you with cash, they gave you an IOU and you credit sales. Now, just like on the purchase side, we're always going to assume that the buyer, whoever our customer is, they will always take the 2% discount. So when you initially record this transaction, you will record it with the discount included, okay? So for us, the way we went about doing it is we did the $18,000 in inventory that we sold, and then we offered them a 2% discount, which means that they're responsible for 98% of the invoice, and that equals $17,640, okay? Now, if they don't pay it, we're like, oh, great, they didn't pay it. Now they owe us more money. But we're going to assume that they will pay the invoice within the terms, okay? So then on March 19th, which is 10 days from the date of the transaction, if they're paying within the discount, it looks like this. We're going to debit cash, and then we're going to credit accounts receivable. All right, so that should look straightforward from what we learned from prior chapters. The only thing that we have added to this is credit terms. All right, now focusing on refunds and allowances. So, all right, for what are some reasons for refunds? So think back of maybe why you would return something, right? So a buyer can return merchandise because it's defective, it was damaged during shipment, or it just doesn't meet the buyer's expectation, right? So in that particular instance, that is a situation where the seller may pay the buyer or may pay the buyer a cash refund, or they may grant them a customer allowance, okay? So think about a allowance, as I mentioned in prior slides, as maybe store credit, right? So they may say, they may reduce their accounts receivable that it's old, or they may say, hey, sorry about that, I'll just give you store credit or something of that nature. Also take into account that a lot of times when you're shipping, when customers are interacting with the seller, maybe they live a far distance away from each other, right? So maybe you're getting some products from Asia or something like that. Well, sometimes it will be more costly for you, for the customer to send you back the shipment because it was defective or something of that nature, right? And so in that instance, instead of having the customer ship you back or paying for charges of shipment, maybe what you just tell them is go ahead and discard it or what have you, and I'll just give you a refund, because we know that the cost of shipping it back to us, to our facility, may outweigh the cost may be too significant. All right, so let's look at this example. So assume that on March 4th, Net Solutions, so we are Net Solutions, right? So Net Solutions pays Blake & Sons a refund of $900 for merchandise that was damaged in shipment. Blake & Sons has agreed to keep the merchandise and make any necessary repairs. Now, in this example, maybe Blake & Sons really needed that significant component to continue their operations. And so instead of shipping it back, they say, hey, we agreed to keep it and we'll go ahead and give a refund, okay? So Net Solutions would record the payment as follows. So we would do a debit to customer refunds payable and a credit to cash, right? So we are the business that we are giving the refund. So our cash account is decreasing because, we're paying out cash. Now, one of the new accounts that we're looking at right now or that we have never looked at before, is this new account called the customer refund payable account. All right, so the customer refund payable account is a liability account. And usually how it works is that at the end of the period, we are all required, or every business is required, to do an adjusting entry for any kind of refunds that they feel that they will be granting customers in the future, okay? And so again, maybe if we're looking at it in terms of, maybe this is March 4, 2020, right? So what we're saying is on 12/31/2019, we did an adjusting entry because we knew that the customer, or any customer, maybe not this particular customer, maybe Blake & Sons, but we know that the nature of being in business is customers will ask for a refund, right? That's part of a business, right? Just like, any other thing. We know customers will buy stuff and then they won't like it, it won't meet their satisfaction or it's their requirements, and we know that they will want to return it. So what we're doing is we're preparing ourselves for that return. Okay, so that's all the customer refund payable account is preparing yourself for a return, granting that customer that return in the future. I also like to think of the customer refund account as something like a safety net, right? So many times when we get paid, we have this, what do you call it? This rainy day fund. So if I can draw an umbrella, right, or something like that, and then we have rain. And this is the customer refund account is similar to like a rainy day fund. Like, you know that maybe your tire will blow out, or, you know, you would need food or something will come up. And so you are putting money aside in advance, knowing that, hey, the inevitable will maybe take place. And when it does, you're trying to make sure it doesn't wipe out your business. And that's what a customer refund account is all about. Okay. All right. So with that, again, the customer refund account, if I can erase for a second, it is a liability account. So if I was reading through this slide and I saw a customer refund payable account being a debit, I would automatically be caught off guard, because if it is a liability account, all liability accounts are credits, right? So again, this goes back to your adjustment entry that you did. If I could draw a T account of what this looks like, what it would look like here is, this is my customer refund account, right? It's a credit. So again, as I mentioned before, on 12/31/19, you did maybe an adjusting entry of $30,000. Now, when March 4th came, so 3/4 came, this is when the customer asked for a refund, like Blake and Sons, and they're saying, hey, I want a refund. And again, you're okay with that, because again, you have already created some kind of reserve, expecting that this refund will come. Okay, so all of this is just being applied. This debit is being applied against the credit that we have already built up. Okay, so more on adjusting entries later. And so what I wanted to show you in this particular example here, or the balance sheet, is the customer refund account goes on a balance sheet, and here with my arrow, it goes right under current liabilities as a customer refund payable account. Okay. So with that, I'll stop this video, and we're going to dive a little bit deeper into refunds and allowances and what that looks like